following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, that rockin' theme means it's time once again for the Option Block, your bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as the old Options Insider Radio Network. And it's a great day to do some option blocking, a lot of stuff going on, a lot of stuff to chat about, and I am joined today on the old all-star panel, starting off with the man holding down the Options Express hot seat, none other than Alex Jacobson. He is the options specialist. What's your exact title over there at OX these days, Alex?
At OX, I'm a vice president of education.
There you go, VP of education.
Yeah, at our parent Schwab, I'm a director. So at some point, we're going to have to merge all those titles.
And I know just in general life, you have the title of just all-around sexy man. So you have many titles on your business card these days, Alex. Must be hard to fit it all on there.
It's a big card. Yes, it is.
And also joining us on the old all-star panel today, beaming it all the way from Maine, I could hear him laughing from all this distance, none other than the rock lobster himself, good old Andrew Giovinazzi from OptionPit.com. Andrew, welcome back to the show, sir.
Thank you. It is always a pleasure to be here.
I'm glad we have you on today because there's a little something going on with a little name you may know a little bit about and may want a second tilt at the windmill at. So perhaps we'll discuss that a wee bit on the old show today. Unfortunately, Uncle Mike could not make it at the last minute. He was called away. His Apple duties called him away at the last minute.
The BBI, very high today for him.
Yeah, BBI. Actually, it would be low. It's an inverse indicator. So if it's low, he could not get away from his desk. So therefore, very low. I know it's confusing. It's one of those hard indicators.
You know
to
what?
keep up
Those
with.
Inverse products, they're
exactly.
tough.
They're difficult.
You really got to understand the underlying, man. You're going to get taken to the hoop.
Exactly. I think, speaking of taking to the hoop, let's take this segment right to the hoop, known also as the Trading Block.
The Trading Block.
All right, and those bells means it's time for the old Trading Block. This is, of course, where we break down the day's trading action, and it was an interesting day on the street with most of the major indices closing up on the day, and S&P closing up close to 0.5%, about 0.4%. Dow a little bit behind, 0.3%, and the good old NASDAQ leading the charge. Tech feeling the love yet again, up 0.7% today. Good old VIX cash selling off, down about 2.5% to close at 1510 on the day today. And there was a lot of tech love. We were joking earlier before. But Apple, of course, not moving as much today as it has been. 1% is a slow day for Apple these days. Only moving 6.5 handles roughly on the day, closing at 589. I'm sure Uncle Mike is out there right now rolling some calls or doing something out there to get back into Apple for some of his clients. But I think some of the more interesting news that we saw that kind of jumped on a lot of people's radar today was your old...
You're about to... Yeah, we had a little action in Zynga today.
Yeah, a little bit of love going on in Zynga today, which is an unusual headline in and of itself. Zynga moving to the upside, of course. It closed today up about 4.5% or 11 cents, a whole whopping 11 cents, to $2.62. Getting some love that there's some people sniffing around Zynga. Zynga may indeed be in play. They filed Form 4 with the SEC, which is an indication that someone is establishing significant beneficial ownership in Zynga. Of course, perhaps an indicator that someone is about to gobble them up whole. So, Andrew, I know you've had a love-hate, leaning towards the hate relationship with Zynga, but we were joking a little bit before the show about, hey, it's your time to get back in, but sounds like you're thinking about it.
Well, yeah, actually, I wrote an article for Market Watch. I write an article once a week for Trade Deck, the trading deck, and I was like, yeah, this is, as soon as I saw that risk reversal go up, I've been watching it. It traded down like 230, around traded $2. I wanted to see it kind of bounce around a little bit. You know, they still got a lot of cash. The business isn't dead, and it just looked like it was kind of $2 was sort of the hard floor for that company. So I like the risk reversal in there. I think at the time, I
was thinking the same thing.
The
Jan 2.5-3 risk reversal.
And somebody's going to make some dough. That's all I got to say. So I've been trying to sell puts for 2 days, and I finally got to sell one today. I was being stingy. I wouldn't hit the bid yesterday, trying to leg into my risk.
You're going to make them pay you, damn it.
And anyway, I just didn't think we could rally like this. But apparently we did.
Yeah, after I heard this news, I started looking at Zynga. I haven't taken a deep look at them in a while, aside from in a mocking sense. And the 2.5-3 risk reversal in January caught my eye. Bullish, obviously. You can do it actually for about, it looks like a 5-cent credit or so, depending on how you work it. The only issue with that, obviously, is that 2.5 to 2 range that Zynga's been living in for quite a while. And I kind of agree with you. I think 2 is the floor. So your downside on that seems to be relatively nominal, half a point.
I'm just going to sell 2.5 puts.
Just going out. It's going out whole hog. Forget the upside.
Well,
why waste money on upside in Zynga?
if it pulls back, I just move the term out a little longer. And if it pulls back, then I'll buy some calls against a credit. But I'm only going to kiss this one. I'm not going the whole way.
You're not going to second or third base with Zynga just yet.
Not yet. No.
You were burned.
I had no idea about the filing. I saw that. Obviously, the guy that put that risk reversal on in size had some idea because he did that around 237, and now it's trading 260 plus. So, but what you gonna do?
Yeah,
hey, y'all had your shot here on the Option Insider Radio Network to check.
Yes, if you ignored all of our mocking of Zynga for the past couple of months and actually dove in, perhaps hit some 2 puts or legged into a 2.5 risk reversal or anything along those lines, you're looking pretty good right about now. This one is a weird one because the floor we're guesstimating is around 2, but I have to look and see how much cash they have on hand. This is a great example of how the rush to IPO for these Web 2.0 names really probably wasn't the most prudent thing for them to do. Zynga just having all sorts of hardship.
As a company, I think they're probably going to figure it out, but they just, they spent some money kind of like a dink at the beginning, and they kind of they were probably on a very high pedestal, and the reality of the market kicked them right into the dirt.
Yes, they were thinking like it was 1999 again. We just went public. We have all these shares that are now capital for us to spend. Let's start acquiring companies. They acquired a handful of people who are an app maker who may draw something for how many hundreds of millions of dollars, an absurd amount. Of course, that app has never seen those levels again in terms of usage. It's like everything else in the App Store. It was a peak and a hit for a week as a fad, then it went away.
The only thing you pay for is Angry Birds. Other than that, every other app in the App Store.
I will say, Angry Birds Star Wars, I thought I'd never pay for Angry Birds again. Angry Birds Star Wars is quite good. My little guy's having a ball with it on the iPad. Of course, I'm kind of having mixed emotions to it now because he's 3 going on 4. He's being introduced to Star Wars in all these ancillary kind of garbage cartoony forms. He's learning about Luke Skywalker from a bird an Angry Birds. Yeah. And I'm saying to myself, I had it all planned out when we were going to watch Star Wars together, a great father-son moment. Now he's getting all these bits and pieces from all these ancillary things. I may have to move up our screening of Star Wars.
My youngest son was 7. That's when
I was hoping to do that, but now I'm thinking I might have to pull the trigger in the next few months, lest he have the greatest spoiler of all time be spoiled to him by like Angry Birds or something, or Lego Star Wars, I don't know, something like that. But which would be just a criminal offense on my part to allow that to happen. Right. So there you go, parenting advice 101 here from the Option Block.
Option trading and parenting advice.
Yes, don't let your son.
I'm so cheap, I won't even let my kids play on an iPad. They have to use my iPhone once a week. They get 1 hour once a week.
Wow. You're an impressively hardcore fellow. Well, I guess when electricity is at a premium like it is up in the hinterlands of Maine, you have to kind of husband your resourresources. So it makes sense.
Go back in the backyard and spin it.
You have to wait till the solar cells are charged up. So I guess one hour a week makes sense.
That's it.
I know, Alex. You're not on the trading desk over there these days. Did you hear any interesting chatter around Zynga? I know our friend Mr. Grigas, who is no longer on the show, at least for the time being, is very excited about this turnaround here in Groupon. Did you hear any other interesting chatter?
Just what came off the desk from John, but the old adage is it's an under $3 stock. That is an option. It just doesn't have an expiration date. If you really think it's in play, I'd buy some stock.
Spoken like a true old school fellow there, Alex. These, you're right though. 260, that is an option essentially. The options are almost, moot at that point when you're talking about $2.60.
And to Andrew's point, the options aren't easy to trade for the market making community. You're going to see generous bid offer spreads in that stock, and if you are long term bullish, I'd buy the stock at that price. I'd buy it and I'd kind of forget about it for a little while.
That's basically what you have to do. I was just too scarred.
He's like, I'm getting back in, damn it. I'm going to show them who's boss.
I got stopped out, so I wanted to find the best level I could.
I will make them feel my pain again.
Let me tell you a quick parenting story. I was in Tokyo for the SIBO, and I came home and my son had learned, my son who's now 22, had learned how to eat Oreo cookies. He was an infant then. And that was one of those moments I was going to share for showing him how to take apart the cookie. So both of you have relatively young children. Don't wait for those opportunities. Do them now.
Take them now. I guess I'll have to push up my planned father-son screening of Star Wars. I guess 4 is an appropriate age in this day and age for that. I don't know.
I'll put it out and do it.
He won't understand all of the nuance, but at least he'll understand it. 'Cause somebody's going to tell him someday, hey, Darth Vader is Luke's father, and it'll be too late. It'll be blue. And then he'll just have a sad, sad childhood from that point on. But yes, there was some other, speaking of sad, there was some other news. And maybe not so much sad as just perhaps overdone. I don't know if you guys are the same way I am right now, but if I never hear the term fiscal cliff again, I will be a happy fellow. It has just been ever since Bernanke came up with that term, what was it, back in February, it has just been beaten into our brains and repeated ad nauseum in every outlet of the financial media that is known to man. Of course, today's rally, in part at least, due to some talks of potential settlement, potential compromise heading towards that fiscal cliff. And we saw, boosts across the broad index. A lot of the names, not just Apple, Ford up about 2.5% today. I was actually looking at Ford. I do have one of the few names I actually have some underlying in, and I was looking at some nice bearish risk reversals out there in AKA collars out in the well, let's just throw around all the terms while we're talking.
To hold your gains.
Exactly.
Hold my gains.
What fun is it if you let the gains go away? I'm looking at the Feb 11-12 collar, and that one is essentially even money, and that was kind of nice right there. So I legged into that one today to collar up one of the few actual underlying positions I have. I always mock Andrew because he loves to trade the underlying. I tend not to touch it myself these days. Somehow I've inherited some through one of my many dealings with Ford over the past couple of years, and it hasn't been a bad do, so I've been allowing it to linger. But this is a good point for, I think, collaring some of those gains off the table.
That's a good one to sell options against, and it's probably Ford is. I don't know how much downside you got in that anymore, unless I view that as the U.S. goes into the tank and Ford will go into the tank. But until, of course, that's why this fiscal cliff stuff is always so. Can we really be as dumb as Greece? I think that's basically what it comes down to with all this conversation.
Yeah.
Can these numbnuts actually turn us into Greece? Take a country that's been so successful for 200 years and wreck it in just a year and a half. I think.
Yeah, there we go.
It is very impressive.
But Ford, you're right. Ford has a bit of a floor as well. It trades around the 9 handle sometimes. That seems to be sometimes down to around 8.5 or so. That seems to be the low end of the spectrum for them. At least lately, of course, they got down lower earlier. But post implosion of the markets, it's been seems to be that 8-9 range. It seems to be the low end for them. But yeah, it's an interesting one. They've been vacillating between that range a lot lately. I know recently I've lamented the fact that I haven't collared or put something else on it when they hit these higher levels, and so now I'm taking my opportunity to just take some of that off the table. Speaking of coming off the table, the VIX is even selling off more as we've been recording the show, down to 1506 right now.
I know. I'm watching the VXX just tank.
It's just some after-hours lack of love here for vol. Andrew, what did you see in today's VIX action? Anything catch your eye that was nothing too surprising here?
Yeah, it's making my VXX P&L make me happy, but other than that, this is again, it's all cliff related, everything. We're talking to our clients at Option Pit when we do the pit report. This is like that product, the VXX, is a day trade, and any gap in volatility we see up is going to be just because these ding-dongs say they're going to argue. And I'm trying to figure out exactly what the public, if we actually tar and feather our politicians, if they don't come up with a compromise that everybody pretty much already assumes is going to happen at some point. But I think right now the volatility is pretty much driven by this. I saw a pretty flat upside for the last couple of days. So I think the fact that we've had the rally, that's come in just a little bit as far as upside skew goes, but the downside relatively flat as well. So there's not a lot of I just think overall the volatility level looks kind of fair for the kind of movement we've been having and the expected movement. But by the same token, as the news gets better, the market seems to like to rally 0.5%, 0.75%, and that's a volatility killer. So if that is going to be the continuing trend, the volatility is going to really start to go lower, because even with our market a little higher, we haven't really seen the VIX like break through 15. Like we haven't seen 14, we haven't seen 13.5 like we did in September when we were at about the 142 handle in the SPY. So the vol's still a little higher than it was when everybody thought things were going to be rosy. So it's not going to. I still think the gravity still pulls it down, but the continuing fiscal cliff talks will keep it at least a little bit. It's going to be hard for it to push, let's say, through 14 on the VIX. Yeah,
not at least until we get some more concrete developments on this whole, here it is a term again, fiscal cliff. You can't avoid it. I'm not sure what other euphemisms you could throw out there.
Well, it's such a day trading thing. Yeah. Ultimately, if you want to buy stock, right now, I don't know. I think the market's kind of fair as long as we don't have as long as capitalism doesn't end as we know it, and of course the politicians can screw it up and they can turn us into a Zimbabwe or something like that, but totally crater everybody's savings. We want to give everybody everything, but we're going to make you broke in the meantime. So, but other than that, I think definitely the wind has kind of been at the market's back. Every time there's any inkling of a compromise, some sort of fiscal cut the deficit compromise, we rally. It's not even funny. We were just up at like 0.75% in a second. So,
all this talk of the VIX, I think, is a perfect segue. We're going to do something a little bit different today, dear listener. We're going to jump into an actual topical discussion that Alex brought up. Might be interesting for you. We're hitting on it now, talking about the VIX. I think what we'll do is close out the trading block and dive right into the Express Block so we can get more into this meaty topic of the VIX and how low can it go, or perhaps should it go.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Xpress Block. And ever since we welcomed Alex onto the show as a regular, he's been filling my mind with all sorts of interesting ideas for topics we could dive into a little bit in depth here on the show. And one of the ones he was thinking about discussing, and it certainly piqued my interest, is this concept of the VIX, and not just how low can it go, but the concept of a low VIX in general. You know, we've hit on this in some of the other shows on the network, particularly Volatility Views. If you're interested in this topic, by all means, I encourage you to check out that program. We go into this in quite a bit of detail. We touched on it a little bit on this show, but not to a significant extent. And really this concept we've seen bandied about a lot, particularly over the past few months as the VIX has been languishing towards these mid to low teens. It got down to the 13 handle range for a while, which is when everyone in the media exploded volatility at lows, volatility at record lows. And it's this oft-repeated refrain that really doesn't have much significance when you start digging into it. So, Alex, I know this has been weighing on you for some time, so I'll let you start off with, you know, your thoughts on this concept of volatility and whether or not it actually is low right now.
Yeah, well, two comments. One is I'll tell you the experience of my lifetime, and I've been in the markets, Chicago derivative community, 40 years, and with the clear benefit of hindsight, in my lifetime, every major move in the market, 87 crash, 89 crash, the bull runs, have come off what was in hindsight, and let me emphasize hindsight, a volatility low for that period. And pre-87 crash, when we simulated VIX data back at the SIBO, I mean, SIBO had simulated data way back before VIX ever began ticking live. And every major event in the market, as I recall, has come off a low in volatility. And I know that's going to drive some people to say, well, so what if you only know it in hindsight? I think VIX is sort of, there's a systemic level that volatility will not fall below. And as Andrew was saying a few minutes ago, we saw the 13s. I think VIX is on its way to 12, barring some real foolishness out of Washington. And I think next year, again, if the foolishness in Washington is resolved, I think VIX is going sub 10. I mean, I saw it pre-87 crash in single digits, and Andrew talked a little bit about this last week where it was down in the nines. I think potentially if you view volatility as a cost of hedging, not so much price dispersion, but a cost of hedging, you have the Bernanke put in the marketplace today. You have low interest rates. The only thing you don't have is as many dollars chasing securities because of Dodd-Frank. You got prop desks that have closed. You've got hedge funds that have downsized or closed. And I think that's a concern. And I think that's why our big swing days really are big swings. They are 200 and 300 points. I think markets are thinner. But I think when you've got VIX tracks the SPX, but the real vol measure, the real benchmark is the spider, because that's where the liquidity is, and it's what keeps the VIX from really getting out of line. I mean, if the amount of liquidity in the spider gives you the ability to hedge the SPX for just billions and billions of dollars, and again, barring foolishness in DC, I think we could see 12 end of this year, beginning of next year. It wouldn't surprise me to see 10s. And maybe single digit next year.
Well, that, of course, is getting to the point of, you know, the historical frame of reference for VIX. This is something I've said a number of times post-2008, is that it seems like the collective frame of reference for VIX and vol in general has just changed completely since 08, 09. We used to have, you know, you're right, Alex, the frame of reference was we were, you know, in the south of 10 quite a bit, and then the mid-teens was a typical range for VIX. And if it got into 20, wow, things are kind of getting crazy. And if it got into 30, which was very rare, then things were off the charts. And now we see people routinely buying Feb 70 calls. We're hanging around the mid-teens, and everyone's saying that's low. You know, it's a completely different frame of reference that people are working with. You know, and it's very short term. You're right. People are looking post 08, post 09, and basing their trades and their analysis around that. When if you add a few extra years to that time horizon, these numbers right now actually seem very out of whack compared to what we used to.
I think there's a VIX pre-spider, there's a VIX post-spider. And I think the amount of liquidity in the spider is one of the things that keeps that VIX low. It's just not going to pop because it's such an easy arb. In the world that VIX was created, when we were back at SIBO, SPX was the standard. It was the benchmark. It was the gold standard, but you had no spider trading. I mean, you could move, $5 billion in the spider today and not move it 2 cents. And as long as I can hedge, that vol number is going to stay low. As I say, my perspective is different than a lot of people, and this comes back to my being old school and actually knowing who Myron Scholes and Fisher Black were. But one of the points they made in their original work was think of volatility as the cost of delta hedging. And as long as I got spiders and SPX and baskets and high frequency and program trading, I can move billions in the SPX without that much of a problem. But the thinness created by Dodd-Frank, losing the prop desks, I think is something the SEC is going to look back at in hindsight. Losing the prop desks has taken some liquidity out of the market, and periodically it gets thin, and you'll see that in VIX immediately.
But Alex, the HFTs are filling in all the voids for all of us, so there's no liquidity problems to be found anywhere.
Some, but the HFTs are, some of them are kind of optional traders.
Yes, definitely. Hence
the
humor lurking in the sarcasm lurking in that. But you bring up an interesting point. There's something we've hit on before a little bit, but I've never had a chance to really pick your brain on this, Alex. I was mentioning before the different frame of reference for VIX, and that certainly is true. But it's not entirely unprecedented because in the last few years we've seen a new universe spring up around VIX and around the S&P of this ecosystem of ETPs. You have notes, you have physical products, you have ETFs, all trading off VIX and S&P and all these various ratios, levered ETFs, crazy 1/6 nonsense things that are floating around. So you have all these new products circulating around there in the ether around VIX, and they're all in many ways pulling VIX and kind of to their own little drummer, their own little tune a little bit. So you mentioned the spider. That's the prominent main liquid S&P ETF, but there's all these little things floating around VIX, and they somewhat seem to be changing the equation a little bit. I'm curious what you think of the notion of VIX and the kind of the tail wagging the dog concept that some people are starting to say, and perhaps that's why we're in these artificially elevated levels, is because we have this whole new universe of products that is, for whatever reason, inherently short Vega, inherently short vol, and they need to hedge. They're buying VIX products or whatever the case may be, and they're the ones artificially propping up these products, propping up the term structure, and creating this artificially inflated environment we're in right now.
Yeah, I think they make the moves a little bigger on the upside and a little bigger on the downside. The ETF, ETN industry, they all have to, I'm going to use a term here that's going to frighten everybody, they all have to do some kind of straight hedging or dynamic hedging. If you go back to the 87 crash, it was dynamic hedging. It was essentially trying to replicate delta using the futures market, and you were a buyer when markets went up and you were a seller when markets went down, and that was a tailwind to every move. Again, add that to the fact that there's less players in the market now. High frequency people are there, but a lot of the prop desks are gone, and you're going to have tailwinds. But systemically, having all those players, I think in the long run, is going to bring vol back in. The range now might be 13 to 18. As you pointed out, there were times it was 15 to 20. When I was at the SIBO, it was 5 to 10. and it lived in the 7-8 period all the time. And when it went to 10, that was like setting your hair on fire. That was like, oh my God, a 10 vol. Systemic vol in the U.S. market, people would argue this might be 5 or 6. I would say right now it's probably 10 or 11 because of the fiscal cliff issue, and that's going to be a tough number to get through. It's like when you ask economists what's systemic unemployment and say, yeah, you'll never get below 4 or some number. I think VIX is going to drift lower. I think that systemic number is going to go back to the 5, 6, maybe 7 area.
It's interesting, too, hitting on that point we were talking about earlier of the VIX and whether or not it is indeed low like it's been portrayed in so much media. We talk about the VIX cash on this show just because it's an easy point of reference for a lot of our listeners. But hopefully all of our listeners have learned from tuning into this show time and again that VIX cash is just an arbitrary number. In reality, what you really have to look at is, of course, the term structure of the VIX futures to really see what's going on from a volatility perspective. I was at a conference a couple of weeks back, and someone out there made an interesting point that right the same day that the VIX cash hit its quote-unquote low that was driving the media into a frenzy. I forget, Andrew, if it was 13 and a quarter, 13 and a half, somewhere in that range. And the second it hit that point, if you actually looked at the term structure of VIX futures, which is the price of actual meaningful hedging activity in the marketplace, not this meaningless abstract cash number, if you looked out a few months, it really, to buy any vol in this quote unquote cheapest ever environment, you were actually paying about 26 or 28 vol in the VIX, which was the equivalent level to the day after, I think it was Lehman or Bear Stearns, one of those two, when the day after they blew up. So you were paying a substantial, huge vol premium. So all this talk about VIX being cheap, VIX being low, a lot of it harkens back to people keying off the cash, not understanding the nuance and the context that goes behind it. And if you want to put on a real meaningful trade on the VIX, even right now, we're trading 15.06 right now in the cash. But I mean, if you put on anything meaningful, you're talking, up into the 20s for really quick for VIX futures. And that's a point that I think is lost on a lot of, hopefully not our listeners, but on a lot of the media and other people who are
expensive.
Exactly.
No, yeah, one thing too, everybody, I'm just saying about VIX, the number, is people are forgetting one thing at Option Pit, we're just what all the different volatilities mean. And having the VIX low, right, that's more of a reflection, I think, of, a 30-day forward, let's just call it what the forward vol that Black-Scholes wants in their model. Like you have to put some sort of flat vol surface number inside a model to generate a value. That's without skew and everything else. And I think that's sort of what the at the money, or the VIX obviously always trades a little higher than that, but that's what that number's trying to hit, right? So just because the current at the money volatility is forward vol is 13, that doesn't mean that volatility 2 months down the road, people aren't expecting something totally different. And the market is constantly trying to price all these different volatilities, what we call it, when Mark was saying in the term structure. You have to understand that every month prices what the event people think for that month is. So if they don't think anything's going to happen this month, VIX is going to be cheap because that's the 30-day forward. That's what we'll call, not exactly right, but that's sort of the forward-looking number for the 30 days. 60 days from now, though, okay, could be a totally different market. That could be a 25 volatility market because we go off the cliff, everybody freaks out, but nothing happens until then. So you've got to understand what volatility you're buying and what time frame and what what the end result you're trying to achieve for. So a lot of this is just kind of educating people on what you just got to understand what you're buying with the VIX near term, what you're buying with the VXX, what you're buying with an SPX straddle 30 days out or 60 days out. So,
Andrew, when you were a market maker, did the firm run a dispersion book?
We kind of ran. We ran sort of a de facto dispersion book. We never actually. That wasn't Group One's game when I was at Group One. Then when I had my own company, we didn't run a dispersion book, but we kind of ran a dispersion book because we're like, man, we're short a lot of Vega right now.
Yeah.
We better do something.
Could you briefly explain what a dispersion book is as quickly as possible? Because I know I'd overcomplicate it.
I don't want to overcomplicate it. Is you're short some volatility in the equities and you're long some index volatility, or vice versa.
Right.
You're just trying to arb volatility from an index against a basket of stocks, and your kind of goal is really not to have a quote unquote Vega position. You just sort of want to let the two pieces come together.
So it's funny. Everyone's been doing that for ages. I'm sorry, Alex. Everyone's been doing that for ages, but it seems like that term dispersion trading didn't become, de rigueur until last couple of years. All of a sudden, that's the hot thing.
SIBO put it on their
exactly.
website.
Everyone's a dispersion trader now. Anyway, go ahead, Alex.
in the 90s, Solomon, Morgan, Goldman ran multi-billion-dollar dispersion books, and the volatility got out of line. They whacked it, and on event days, if you saw huge volatility in the S&P, they'd sell it and they'd buy the top 5 or 6 vol components, and they'd wait for them to come back in. And I'm not saying it always worked, but if you took Apple out of the equation right now and looked at the top 5 or 6 issues, the GEs, the Procter and Gamble's, their implied vols are nothing.
Yep.
Right? They're nothing in this environment. So, and this is a debate we're not going to solve. But if I look at term structure and I look at dispersion, something's wrong. Something's
those guys have been not making any money for the last couple of years either.
I get it, and there haven't been a lot of opportunities there. But the day they cross, if there's still money out there doing dispersion, they'll bang it into line. I think that's a Dodd-Frank issue as much as anything. And I think that's one of the issues in the term structure is you've taken the arbs away.
Right. You guys, there's nobody providing liquidity out there anymore.
Yeah, well, it's
the Dodd-Frank thing. One thing about Dodd-Frank is just, okay, if you want to be a bank, you can't use the government's money to bet. I don't know why they just can't figure that out. Here's the trading part of the bank. Here's the prop part. Here's the non-prop part, and, deal with it.
So this is more Washington noise. And in the real world, if you were some of the larger banks, the JP Morgans and the Goldman Sachs, and you didn't have the political issues, you'd drop out of being a bank.
Right. Well, I guess so. I mean, I don't know enough about what they're actually going to implement with Dodd-Frank anymore. I mean, it's just kind of, what's funny is the two guys that are responsible for the financial crisis, really, both those guys with all their trying to get banks to loan to everybody that doesn't have 2 cents to rub together, they wrote the financial rules. Does the irony of all that dawn on anybody?
There's a lot of ironies when it comes to Dodd-Frank, not the least of which what you pointed out, that, of course, none of us even know what the heck's really the ultimate result of all this is going to be. It's being written on the fly in a lot of scenarios with a lot of places, like the SEC, and that hasn't really shown much of an interest or inclination toward options. Now we have another change of the guard over at the SEC, even though the last one wasn't exactly very pro options. I don't expect much from the new one either. So yeah, from an options perspective, I think a lot of people washed their hands of the SEC a long time ago, and just assume that as long as they don't screw it up too badly, we can make do with whatever we get coming out of Washington there. But Alex, it's an interesting topic, I think, to discuss just in general, going back to sum up our conversation here about the VIX. I think all of us on this show, for the most part, tend not to subscribe to that viewpoint that, VIX is so cheap right now, because we've all been doing this for a while. We've all seen VIX in other time frames. We all know it has the potential to move lower. We all know that there are a lot of other realities lurking underneath that VIX cash number, like the term structure, which is bid out like crazy. And so the reality, the actual practical cost of trading vol is much higher. I think at the end of the day, Andrew, I think you'll agree with this, our ultimate recommendation is for everyone to run out right now and just load up on TVIX. Because that's where the action is. That's where the smart money is right now.
Exactly, and I heard some unbelievable horror stories. It's like I've seen a lot of bad things happen, and it's just, for the price of just coming into Option Pit for like $99 a month to learn about how volatility works, it's amazing how many hundreds of thousands of dollars we've seen just chucked away because people have no clue how these products work.
TVIX closing at 0.86 today. So still around in some way, shape, and or
exactly.
form.
No matter where the vol goes, it goes lower.
And Alex, I don't want to hijack all of your Xpress Block. If you have any other points you wanted to bring up before we dive into some listener mail, by all means, go ahead, sir. Now is your opportunity.
No, but I think Andrew's point is valid. I think, and I say this every time, and I know I sound like I'm preaching, but the distinction between a really good options trader and an ordinary options trader is having a view of volatility.
Yes, we've said that. I've said that many times, certainly, that at least to me, the distinction between retail and institutional is retail is very directionally and delta-oriented. Professional is more vega volatility-oriented, and that's kind of never the twain shall meet unless they become very sophisticated, in which case, the retail anyway, then of course there is some overlap. But interesting stuff, a lot of grist for the mill. I should mention to our listeners, TVIX did about 5 million shares today. So people still loving that TVIX.
Money.
Yes, talk about throwing away 86 cents on this one. That's a great trade there. But anyway, yes, love TVIX. We're big fans. This show brought to you by TVIX. And with that, we're going to wrap up the Xpress Block and dive right into our listener mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and this is, of course, the portion of the show where we break open the old mailbag and allow you, the listener, to join us here on the old All-Star panel. And first up, we have an email from Emil Passiri. I hope I'm not butchering that, Emil, but he writes in, I love the show. Do you know of any source? Well, first off, thanks for the love. We always love a little love here on the old Odd Block. Never turn down some love. But he goes on to write, do you know of any source that publishes daily updates of options showing a significant horizontal skew? I know of several that publish daily updates of vertical skew, but none that screen and publish horizontal skew updates. Thanks so much. This is an interesting question, not one I can recall receiving in recent time. Of course, horizontal skew, another term for that, of course, is term structure, what we were talking about before with the VIX futures, where you dial it back, looking at it typically on a monthly view. You look at the term structure of a product and you see, well, January is bid up versus August, and it kind of gives you a more 10,000 foot level, 10,000 foot approach to how the months are trading in comparison to each other. I personally don't know of any services, maybe Andrew or Alex, you do, that do this.
Does OX do a comparison? I know that LiveVol, there is a Sigma. It's not free. That's one thing I learned about trying to be in the product and data business.
I think we can hopefully assume he's willing to pay.
I'll use it if it's free. I'm like, there's a problem with that data cost there. But anyway.
We do it in our chains, and the guy who built it is a former O'Connor guy, but it's in the chain, which means it's cumbersome to see. The only services I know that do it are far from free. They're really expensive. They're the professional services, and you're literally, and you're talking a few $1,000s a month. There are micro hedge products that do it, but in the individual investor community, it's just too expensive. But having said that, let me make a point here, which is when you start to look across term structure, and I'm going to open up a Pandora's box here, I know this, but when you look at really long-dated options, I would caution investors to be a little leery of the Greeks and long-dated options. It's very hard to actually harvest good Greeks in long-dated options. You actually need a LEAPS model, a separate and distinct LEAPS model. And I'm not sure anybody in the trading community, both retail and institutional, does that well in the free environment.
You know, as we're talking, I'm looking here. I use LiveVol a lot. I'm looking, and I use them for a lot of screeners during the show. I don't see, there's a lot of screening tools here. I don't see anything that gears towards term structure or anything like that. And I also can't think off the top of my head, like, you can find it if you look in some of the tools buried in OX and other brokerages. That's a bit of a bit of an effort, but of services that will alert you to skew or term structures that are out of whack. Yeah, I don't really know of any except for maybe some of the ones Alex is referencing that are geared towards institutional audiences. Yeah, and they're certainly quite expensive. I think part of that is that they're not as many people are looking at term structure as are looking at the individual skew on a particular option. A lot more people are trading verticals and then they are trading calendars and diagonals and things like that. And the term structure is really useful for exactly that, for spotting some opportunities for great calendar spreads. This month is probably a bit up out of whack versus the other one, but even then, it's very much a 10,000 foot view. You're not going to look at just that and execute your trade. Then you're going to look into the individual skews of those months, and so it still comes back to the individual skew. So when I look at term structure, it's more of a starting point, a frame of reference, if you will. I look at that and say, okay, there's something out of whack here, something I should investigate further. Now I will dive into some of my historical screeners, some of my skew, look at the skew, see what's really causing this thing to be a bit out of whack, and some of the paper flow, and get into all of that. So even if I had a service like that, I certainly wouldn't be trading off. I'd be more keying and saying, oh, here's something a little bit maybe to be aware of, but nothing I could, immediately pull a trigger, buy June, sell August, 1 by 2. You have to do a little bit more, I think, research than that. But an interesting question, Emil. I think thank you for that. We'll keep an eye open, certainly, if we find any that are reasonable. I'm sure if you're willing to shed out some cash, though, then it could work. One more quick listener question here. This is a bit of a tangent, but a kind of a fun one, so I thought I'd throw it in. This one comes from our comment system on our site by Liam. A fine British name for a British commenter. He writes, "Hey, Option Block gang. Great show as always. Again, thank you for the love. Liam, I have a question for you." This goes back to, I think, what we were talking about before, Andrew, with the Microsoft conversation. Since Microsoft seems to make such bad decisions for itself in terms of buying companies, what would you do if you were in charge of investments over there? Do you ever plan on making it out to London? I would love to buy you a pint. Well, thanks for that. Maybe if we have the next live Option Block session should be in Piccadilly Square. What do you think there?
I think it should be in London, and you should fly all your contributors out there because we are fantastic.
I agree.
Beings.
Bangers and mash all around.
Bangers and mash and a pint of.
If I was in charge of Microsoft investments, I certainly probably wouldn't have bought Skype. I don't see, at least not for that level. $8 billion. I know there were a lot of users, and there are a lot of users on Skype, but seeing it and Microsoft tends to chase too often. Look what they did a few years back. What was it with the Quantive? Google went and bought DoubleClick. They were the market leader in online advertising. Microsoft says, hey, we have to do that too. Who's the next one we can find? Oh, it's just a Quantive thing that no one's ever heard of. We're going to spend whatever it is, $8 billion on this thing that they promptly went on a few years later to write off completely. So terrible chasing investment.
Although HP is making them look like.
Yeah, you're right. HP is giving them a run for their money. They did the same thing with Skype. They saw other people buy it. Skype had already been bought once and completely flagged at that, and they flipped it again to Microsoft. So they were also ran on that deal as well, paid through the offer for that. They could have got that much cheaper. I don't really. We use Skype all the time. I don't know if I see the monetization value of every Skype user. I think they're trying to see it as some sort of YouTube model. Even then, Google has had a hard time until recently making any money on something like that. They did all right with the Facebook acquisition. The investment. Granted, at the time they were lambasted for it because they ridiculously overpaid, and they certainly did. I think their investment at the time valued the company at something like $5 billion, which was absurd at the time. But of course, like any marketplace, all that matters is if you can find some other sucker to come in after you to pay more, and they certainly did at the IPO. So they did all right on that deal. So they probably 1 for 3 in recent big investments. I think if I were them, I would stop chasing so much. It doesn't matter what everyone else is doing. You're Microsoft. You can make your own. You can make your own waves. You have enough cash, and I think doubling down on what they're doing with the touch and thing is interesting. I think maybe they kind of screwed the pooch a bit with Windows 8 in that burying the start window, all the things people are used to, and going pure hog on the touch is a bit dangerous. I give them points for daring on that, but I don't know if that's the greatest investment of all time either.
I think touch is going to be the way to go. I spent enough time with all this 3D stuff for a couple years, and I honestly think everybody's natural inclination. What do you do when you use I guess you use an Android, right?
I do.
how easy is it for you just to use that?
It's gotten much easier to the point where my wife actually, when it was time for her to pick a phone yesterday, 2 days ago, I said, hey, iPhone 5 or my Google Android phone. She chose my Android phone, and she's been on iPhone forever. So more and more, the wife factor is coming into play here.
The touch idea, while it's early, and Microsoft is probably, trying to be early, they're throwing some resource behind it. They kind of hedged a little bit with, how Surface works. But, if you think about it, Microsoft has an ecosystem of probably $800 billion a year of other companies that use Microsoft products to sell their own product. So it's not, I think a lot of people don't really understand the Microsoft's business. They're like, oh, they're just Office and all this stuff. That's true, but all that stuff is buried in a lot of other companies, like Excel and just, it's a huge business that for some reason every analyst in the world hasn't quite figured it out yet. So when Microsoft is going to roll this stuff out, full disclosure, the company I was with, we are a Microsoft partner because our 3D interface worked out of an Excel spreadsheet. Basically, the data that was in the spreadsheet, you hit a button and you got a 3D surface, so you could see 100,000 data points at once. So there's a lot of, like I said, there's hundreds of billions of dollars, or probably close to 800, maybe $900 billion probably by this point, that do that. So, Microsoft has a pretty solid franchise in this, which is why they kind of still grow. But I agree with you on the fact that maybe they should stop buying companies. They do much better when they kind of see a market and they take their stuff and they kind of morph it, to fit into the market, so to speak. And that seems to what has worked for them over time. I don't know how much innovating they've done. Possibly maybe now the Surface for the PC and things like that. That's probably one of the more recent, like I would say, an innovation type thing.
Yes, that's probably one of the few recent examples of innovation I could point to at Microsoft and saying, wow, this is something actually different.
Right.
That and Windows 8.
Right. But, a lot of their stuff underpins a lot.
Ironically, Microsoft, one of the few names down today, down about 1.5% to south of 27.
I know, Microsoft and Intel. It's very weird. They're both at lows of the year. And I think that's one of these things where people think everybody's just going to move to a tablet and a touch phone. And they're not going to use computers anymore to do work, or people aren't going to have PCs anymore. I think it's going to be a while till a tablet, like I just thinking it this way, like how I could trade on a tablet. I could see possibly how you could get there, but you're always going to kind of want that keyboard part. So I'm not, as people like, what would you prefer to work on? If you're going to read, I just don't see the end of the PC, but also what drives those tablets and phones. You need the infrastructure. Obviously Intel still makes chips to, service servers and all those. So
I guess I think I'm smelling on your part, Andrew, perhaps another bullish risk reversal candidate here in Microsoft, or at least a short put candidate in the near term. Alex, here's your chance to put on your CEO of Microsoft hat for 2 minutes. What would you do out here, or do you want to demur?
I'm going to do exactly what they would do. And Microsoft and Intel are classic examples. They are, and people would argue this term, mature businesses with piles of money, and every once in a while they buy a call option, and some of them expire worthless. But in the VC community, if I'm a true venture capitalist, and arguably some of these investments are not true VC. I have two nephews who lived a mile from me in Deerfield, and both of them now live on Mercer Island in Seattle. And one works for Microsoft and one works for a VC company. And here's the thing about what Microsoft is doing. If I strike out 8 times and hit once, I'm golden. You just got to realize that if you're doing real risk investing, what do we tell investors about buying puts or calls? When I started my career at the brokerage community, I worked at Merrill Lynch, and we jokingly said the worst thing that can happen is a customer buys a call and it doubles because all of a sudden they think they got it figured out. Microsoft, companies like Intel, Microsoft are going to have to swing at the fence every once in a while, and they're going to make a lot of bad investments. Andrew, as you pointed out, HP excels at it. But every once in a while, they're going to have something that hits, and it's going to be a 10-bagger or a 12-bagger. And if I were Microsoft, if I were Google, if I were Intel, I would be investing in those technologies, and it would fail a lot. But one of those technologies is going to change the industry. One of those technologies is going to do for them what they did to other people. And, losing money 3 times, Mark, you pointed out there 1 for 3. 1 for 3 in VC makes you a genius.
Yeah, that's true. It's a different frame of reference entirely over there.
Yeah. And I'm not sure what the statistics are, but if I were sitting on a bag of cash and, interest rates are, let's round, nothing, Apple runs a hedge fund today, right? Apple runs a hedge fund out of Nevada today, and they will quickly be the largest hedge fund in the United States in terms of their trying to invest their free cash reserves. And I would strike out a lot, because every once in a while there's going to be a home run.
That's true. Microsoft has a little bit different frame of reference than us, and they could afford to play the long game. Speaking of long game, even though we had a truncated panel today, we have run a bit long on the old option block, but a lot of great conversation. Of course, a lot of great questions from you, the listeners. I want to thank all you guys for joining us today and sparking such great conversation. We love it when you, the listener, gets a chance to chime in and give us your 2 cents on the issues of the day. Sometimes not even option related, just fun conversational topics for us here on the show. But unfortunately, that is going to do it for this episode of the Option Block. But before we go, I'd like to check in with my cohorts here, my partners in crime, to see what they have going on in their respective necks of the woods that may interest you, the listener. Starting off with you, Mr. Rock Lobster. What is coming up in the land of the pit?
Coming up, actually, to Alex's point, you want to learn about volatility? Learn it from Mark and Jim Bittman in Chicago this Saturday. I think there's a few slots open for directional volatility trading, basically making sure you buy the options that are going to do what they're supposed to do, or sell the options, all right? Everybody likes to sell options, theta, theta, theta. But understand this is your opportunity. Go to www.optionpit.com/events, sign up. And Mark will give you a deal on the gold course as well. But this is a great opportunity for an all-day webinar on actually useful stuff that you can go out and trade with. That's our big thing for the month. That's this weekend, December 1st.
There you go. So if you're in the Chicagoland area, by all means, come check that out, or you can beam in via webinar too. It is the 21st century, after all. You don't have to be here in sunny Chicago. You can join from the beaches of Bimini if you choose. How's that for a little bit of alliteration for you?
Very nice.
And speaking of beaches that begin with B, Alex, I believe you guys have an event coming up in Boca. Am I correct?
Yeah, December 8th, the team is in Boca. December 1st, it's in Houston. If you're on the Schwab side, Schwab customers, on Monday, look at your email. You'll be getting an email about the new treatment of good till cancel, bracketed and good till cancel orders, where Schwab's going to align themselves with the rest of the industry, which means when there's a corporate event, they're going to take the GTCs off the books so that there's no confusion. And one last tidbit, very important in my community, 110 bidders for Hostess and their business cards.
There we go.
So
the Twinkie will live on.
That and Starbucks $7 coffee. So
I think if there were Hostess calls, you'd be long right now, Alex. What I think.
I'd be long synthetically. I'd 110 bidders for different parts of their business.
I think we're all naturally synthetically long, Hostess. It's just how it works out.
Oh, I'm longer than anybody you know.
All right. Thank you for that, Alex. And with that somewhat disturbing image, I think we're going to close out this episode of the Option Block. Of course, if you'd like to join any of your fellow listeners on the show today, you can shoot us an email, questions@theoptionsinsider.com. Just put question for the Options Insider in that subject line. You can also get to us via our comment form. There is an email section of that on our website. Just surf on over to theoptionsinsider.com. Of course, you can also post a comment like our friend Liam here, and we can get to those as well if they're interesting or perhaps relevant or just kind of fun sometimes. And of course, you can find us on Twitter at Options or on Facebook. Just search for Options Insider. A lot of great ways you can find this program as well as all the other programs on our Options Insider Radio network. And on behalf of all of my fellow compatriots, my partners in crime here on the Option Block All-Star panel, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, and of course, sending in your questions. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.